So common questions with pullbacks is, how do you know it's going to reverse back up? This could just really be the beginning of a big down move, and you're trying to pick a bottom in a smaller down move. Isn't that what you're really doing? It's really not a pullback, right? It's just the start of a down move, and you're just trying to pick a bottom in a down move. So that's a valid question. And the second question is, how do you know when to enter? The pullback might work at this particular point in time, but then again, it could become a deeper pullback and then reverse back up. So effectively, it'll stop you out and then reverse back up because you didn't pick the right pullback point. So it's very important to know exactly where to define that entry. And we'll get into that in a few minutes. The next question is, how do I enter? Especially if it's a strong down move. Should I be buying into that big red bar, especially if you get very strong red bars? I mean, it doesn't feel right, right? You get a big spike down and you're buying into it, and the expectation is that the trend is going to resume, but gosh darn it, you're buying a red bar. You know, it doesn't seem right. And lastly, I missed the slide. I think what happened, or so what happened there, but I did have another. Let me go back to here. And basically, lastly, the question is, where should my stop be and a possible initial target? So once you do get in on a pullback, how do you know where your stop is going to be? And how do you determine that? So that becomes also very important. So let me go next one. So the methodology I'm going to do is, let me just do a quick overview of it. It's actually from a gentleman named Al Brooks. So if you are familiar with his books, it's actually defined in book 2, chapter 19. And I've got a couple of slides on him in a few minutes. It's very simple. It works extremely well. The focus is on low risk entries, always looking to minimize your risk. There are no indicators, and the primary focus is on something called trend channel lines. And we'll talk about it in a few minutes. And there's no subjectivity on the setup. Everybody sees the same thing. But there is subjectivity in entry because one particular stock, a pullback setup on one stock may not necessarily be as good as the pullback setup on another stock. And there are a lot of other factors that come into play. That's where the subjectivity comes in. It doesn't come in on the setup. It comes in on the whether you want to enter or not. And you know that becomes really important, especially if you've gone through the IBD methodology, because they've got all these patterns, the cup and handle patterns. And oftentimes you look at the cup and handle and say, man, I don't see no cup and I don't see no handle. How did they see it? And oftentimes what you'll hear them say is, this setup worked even though the handle was weak or the cup was shallow or the cup was too deep, et cetera, and it'll still work. And then if it failed, they'll say, hey, this failed because the cup was too shallow or the handle was too deep, et cetera, et cetera. So you have no real valid way of judging it. Should I take it or should I not take it? And the pattern itself becomes subjective. Wouldn't it be nice to have a setup where there is no subjectivity? Everybody sees it. It's clear as day. And it's so clear that you can even program it. And I'll show you the programming part of it a little bit later on. So the best use of it is mostly for end of day investing, and I call it for aggressive investing because it works really well on aggressive stocks, and we'll cover that in a few minutes. And especially big mover stocks like IBD stocks and stocks that move big, that have a strong momentum, that pull back, and the probability of it resuming that momentum is really, really high, versus doing it on a small cap, crappy $2 stock or something like that. You really want to do it on very good, fundamentally good stocks. Like I said before, their setup works on reversals and IPOs. And one of the things I've focused on a lot are IPOs. That's one of my specialties is IPOs. I did a whole presentation on IPOs at the MISIG last year. And I talk about IPOs off and on at the meetup as well. But here we're only going to be covering pullbacks. Like I said before, it can be automated. And one thing, some caveats, it doesn't work as well on intraday because most of the time intraday you're getting reversal setups, you're not getting with trend setups. So there are fewer of them. So if you try to do this intraday, It's going to work, except you're going to get a lot fewer setups. And we'll look at the intraday charts in a few minutes. We'll look at today's chart, and we'll look at the last couple of days as well, and we'll see how it panned out. And the second thing you want to keep in mind is that it doesn't work in impulse mode. Impulse mode is when something is trending extremely strongly in one direction, and we'll look at an example of an impulse mode shortly. And here's another thing: it doesn't work after danger zones have been reached. I did a whole presentation on danger zones last week at the IBD meetup. I'll mention it briefly when we get to the charts, but I don't have enough time to cover that. Well, anyway, here's Al Brooks. He's got 2 good websites, and he's got a lot of stuff for free. So you don't have to buy any of his stuff. You can get a lot of it for free, or you can buy his books as well. He's got 3 sets of books. Very, very difficult reading. I think I did 2 presentations on his setups at the SMT, was that about 8 years ago or something like that? And they all came from these books. So now he's got a video course, etc. I mean, lots and lots of resources. So there's, and as well, besides the websites, he's also got a lot of recorded webinars. So if you're a more visual person, you can actually just watch his videos. Really, really good stuff, and they're all free. So as I mentioned before, if you want to learn about this particular setup, it's in chapter 19. It's basically something we call a wedge pullback to the trend line, something like this, or a pullback to a prior support. And I'll cover that in more detail in a few minutes, but I just want to show you that there's more reading that you can do to learn about this stuff. So let me actually get into a little bit more detail on this rather than just an overview. Basically, what we're looking for in a chart are basically trend lines and trend channel lines. We'll get into details on how we draw those in a few minutes, but I just want you to be aware of what they are. Second, moving averages, and we will also look at multiples of moving averages. And the third item we have on the chart are Keltner bands. Now, Keltner bands are different from Bollinger bands in that, as Dennis was saying, Bollinger bands are standard deviation bands. Keltner bands are true standard deviation. They're actually exact standard deviations, if we can think of it like that. When we look at the chart, we'll see it. Bollinger bands have squeezes. Keltner bands don't. They're just true multiples of a moving average. So 3 types of trades typically. Pullbacks, that's what we focus on. That's our presentation for today. As you get more advanced and you get good at this, you can do reversals on IPOs, and then finally regular reversals. And I usually say you do it only if you're advanced. Once you've nailed pullbacks and you know how to trade pullbacks properly, then you can move on to reversals, but not beforehand. The entry technique, I have a separate slide on the entry technique, so I'm going to skip over this for now. So we do this primarily on 3 types of stocks. Like Dennis was saying before, we want to focus on stocks that have high growth potential, that are real big movers. So 3 categories we focus on are tech stocks, medical stocks, and Chinese stocks. Now, Chinese stocks, even with all of this coronavirus stuff, they've actually, a lot of them have still done pretty well. But you want to keep your eyes on them, because when they move really, really big. And when you can get big moves with low risk entries, with a pullback setup, those are really, really nice entries to get in on. Now, rarely used are other things like volume, MACD, stochastics, ADX, all of this other stuff, divergence, squeeze, none of that stuff. You can use them, but you don't have to. So the focus is that the more stuff you add, the more complex it gets, and the more difficult it makes to make a decision. Because what happens if your MACD hasn't crossed, but your stochastic is oversold, but your CCI is not there yet, your ADX is not trending yet, you know, all of this complications that you have. So if you minimize all of that stuff and just focus primarily on just a few things, and one of the things we focus on are primarily just trend channel lines and nothing but trend channel lines at a particular moving average. And if once you get good at it, you will find that you don't need any of this stuff. Although these things do help, especially if you're doing scans. If you want to find oversold stocks, the stochastics indicator is really, really nice to find oversold stocks, etc. Any questions? So let's keep moving on. So there are 4 key concepts that we want to focus on to get this methodology done. The first is understanding what pivots are. So it's a different way of defining pivots. The second we're going to cover is how to draw trend lines and how to draw trend channel lines. The third is what are combo setups. So these are the combo setups I referred to earlier. And lastly, we're going to go over how to enter a trade and how to exit a trade. And we'll look at lots of examples. Okay, my last line for some reason seems to be disappearing. Okay, so first one, what are pivots? What exactly is a pivot? Basically, the way I'm using it here, a pivot is another word for a swing high or a swing low. If you're familiar with the concept of swing highs and swing lows, that's exactly what it is. Basically, it's X number of bars on either side. So here I'm using 5 ring pivots. 5 ring pivots means there are 5 bars on this side, 5 bars on the other side. So this would be a low pivot, and it's usually marked in green. Likewise here, I've got 5 bars on this side, 5 bars on this side, so I get a circle here indicating this is a pivot. Now here, I've got 5 bars on this side, but I don't have 5 bars on this side. I've only got 3. So you won't know this is a pivot till we get 2 more bars. After that, we'll know if we get a pivot there or not. So the reason these become important is because these pivots are how we're going to draw the trend lines on the trend channel lines. So we don't draw trend lines off of any other prices except these pivots. So we use these to draw our trend lines and trend channel lines. With that being said, let's do a live chart here. These are the cues, and you can see the red dots here refer to 5-bar pivots. So basically 5 bars on either side. So to draw a line, whether it's a trend line or a trend channel line, all you need are 2 dots, right? Two points to draw a line. So what happens is that when you get this one and you get this one, you can actually draw a line and you can project it forward and you can see, did price intersect that line? And that'll give you a warning sign, either a warning sign or a potential trade entry sign, whether you can take a trade or not. And likewise here we've got at least 5 bars on this side, but we only have 3 bars on this side. So if the market stays above this level, above this low for the next 2 days, we'll get a dot here. And once we get a dot here, we can start connecting lines. So we can start connecting dots with lines. So you could draw a line from here to here and extend it forward. We could draw a line from here to here and extend forward. And these areas where our lines would be projected to become potential target areas where price would come to. So that's why we use these pivots. The pivots become really important because